All right, if you're doing business in the UAE, the rules of engagement, yeah, they just got completely rewritten. Welcome to This Explainer. Today, we're decoding the urgent new realities of UAE transfer pricing. We're going to break down exactly what the law actually requires, how you can comply, and honestly, most importantly, how to protect your business. Let's get right into it. So let's just shatter a massive myth right off the bat, okay? You hear the words transfer pricing, and you probably pictured these giant multinational conglomerates moving billions of dollars across international borders. But here's the reality check. This compliance is now a standing requirement for essentially every UAE business dealing with related entities. It really doesn't matter if you're just a local enterprise with a couple of sister companies. These rules, they absolutely apply to you. Which brings us to our first core concept, the arm's length principle. To really wrap our heads around this law, we have to understand its foundational mechanism. Basically, it means any deal you strike with a related party has got to mirror the exact terms that independent strangers would agree to in the open market. No sweetheart deals for your sister companies, and absolutely no artificially inflated prices just to secretly shift profits around. Every single transaction has to look, feel, and be priced exactly as if you were dealing with a complete stranger. Now, what's super interesting is how the law actually splits these relationships into two very distinct categories that you absolutely must monitor. First up, we have related parties. So think of a sister company where you have 50% or more common ownership or control. Then secondly, there are connected persons. This is a totally different group that covers the actual human beings running the show. The owners, the directors, the officers, and even their relatives. And knowing the difference between those two categories is incredibly critical. Let's say you're making payments to that second group, like maybe you hire a director's cousin to provide some consulting services. Well, the rules act as a really strict safeguard here. You can only deduct those payments from your taxes if they are strictly at market value. It's basically a roadblock to stop companies from artificially lowering their taxable income through backdoor payouts to the people in charge. Moving right along to Section 2, the 5 recognized pricing methods. So the UAE corporate tax law actually directly mirrors OECD guidelines. This means the Federal Tax Authority is going to use 5 specific, globally recognized methods to test your pricing. These range from the comparable uncontrolled price method all the way to resale price, cost plus, transactional net margin, and finally the transactional profit split. You are being strictly evaluated against these exact international standards. But listen, you can't just pick your favorite method out of a hat just because the math looks a little easier. The law actually dictates your choice based on 3 strict criteria: the specific nature of your transaction, the availability of comparable market data, and the functional profile, which basically just means who is actually taking on what risks. The burden is entirely on you to prove that your math accurately matches the open market. All right, Section 3, navigating the paper trail. Let's talk about the paperwork. If you hit certain revenue or transaction thresholds, you are suddenly on the hook for a very concrete 3-tiered paper trail. First up is the master file, and that outlines your group's global operations, kind of the big picture. Next is the local file, which drills down into your specific related party dealings. And finally, you've got the disclosure form. That's essentially a summary of these transactions that generally has to be filed right alongside your corporate tax return. Now, your master and local files might not actually get submitted with your initial tax return, but do not let that give you a false sense of security. If the FTA knocks on your door and requests them, a 30-day clock starts ticking immediately. You simply cannot wait for that dreaded audit notice to arrive before you start scrambling to pull all your paperwork together. Which leads us perfectly into our final section, protecting your business. The source material gives a really explicit warning here, and I want to highlight this quote. Even if you believe your related party pricing is defensible, contemporaneous documentation is what protects you in an FTA inquiry. Honestly, your gut feeling? It doesn't matter. Contemporaneous documentation, meaning solid evidence and analysis that's gathered at the exact time the deal happens, is your absolute ultimate shield. Because if you wait until the FTA asks you to justify your pricing, it's just too late. Imagine trying to frantically hunt down 3-year-old emails to explain why you priced a service a certain way back then. It's a nightmare. The material warns that this kind of hindsight, this reconstructed reasoning, provides incredibly weak evidence compared to documentation that was carefully locked in on the very day the transaction actually occurred. So I'll leave you with a final thought to evaluate your own operations today. If the FTA asked for your pricing justification right now, this afternoon, would you be ready? Are your related party transactions fully documented right this second, or are you kind of just hoping you'll figure it out later? Transfer pricing in the UAE is no longer some fringe issue. It is your daily operational reality. Thanks for joining us for this explainer, and we'll catch you next time.